Recently, we saw a considerable increase in interest rates on fixed deposit rates and loans. Did you ever think about why it happened? Well, if your question is this, then watch this video to find out the answer. First, let's have a brief idea about the economy and interest rates. Economy. We all know Sri Lanka is going through an economic crisis this year. This economic crisis leads the government not to balance imports and exports, and we ran out of forex reserves. It leads us not to import our necessary goods and services. Now, for the same population, we have fewer goods and services. So people have to pay more than the actual price to acquire the goods and services. In other words, this leads to a demand increase than a supply. As prices increased, government has to do something to overcome the problem. So they have to print more money and float it around for emergency solutions. But this creates inflation. Due to inflation, the prices tend to go up, demand increase, and this loop repeats. To overcome this, what can we do? Another effective solution leads to our next topic, interest rates. Let's see. We all know the economy is dropping because the demand is higher than the supply. We can't increase the supply now because we don't have forex reserve, and importing goods and can be very challenging. So the only way is to decrease the demands. Governments can't tell people so don't spend their money. So the only way to stop public spending is by locking public funds. Let's see how this is going to work. The first government implemented laws to increase the interest rates for investments and loans. This leads to two outcomes. First, people who have money in their saving accounts tend to put the money into a fixed deposit for a specified period of maturity time. Most people get loans like credit cards, homes, or cars to fuel their needs. Now the loan interest rates increased, so people are less likely to borrow money from banks and spend on things due to high interest rates. See what happens now? A lot of money will be deposited into banks and there will be less money given out. So people don't have a high number of liquid funds to spend vastly. So people will buy less. This decreases the demand. We can't say demand and supply will be balanced, but we can decrease the demand percentage by a lot. And on the other hand, the government will give securities like treasury bills and treasury bonds to get the money from the primary dealer and use that money for development purposes instead of printing more money. However, we can't simply achieve this state because, let's say, you invested $100 into a fixed deposit or treasury bill for 1 year with a 20% interest rate. You can't access your fund for only 1 year. At the end of the year, the government need to provide $120. So from where did that $20 come? That $20 generated from the government has to complete its correct planned development process and make $30 from your $100 and pay you back $20, and government keep $10 for its next developments. A normal investor can go to the bank and invest his or her money, but how government can increase its money? It's through foreign investments, exports, tourism, long-term asset projects, and much more. If government achieved those things as planned, then everything would be fine. We will start to recover back on track. In the worst case, if things don't go as planned, then the government can't increase its revenue. Let's say the government only earned $10 from your $100 investment. To pay you back $20, it has to print $10. As I said earlier, if the government prints unnecessarily, it increases inflation much more, and we will move on the worst track very quickly. Interest rates not only decide inflation and the economy, there are much more things that affect inflation and the economy. But in this video, let's discuss the relationship between interest and inflation. So, in this economic crisis or recession time, you have to be very aware of the financial markets and you have to control your spending habits because you have to face the hard times of your excessive spending. Instead of spending your money in a recession time, try to invest and grow the money because recession is a good opportunity for investing in short-term markets like government securities, fixed deposits, and resources like commodities, real estates, or lands. However, investing in the stock market can be a little risky because the market can go down further based on investors' sentiments. But getting into the stock market as soon as possible at the end of the recession may be one of the wise investment decisions which will give a higher return on investments later. But in a peak recession time, it's better to invest in short time investment schemes. Some additional pieces of information and in-depth points are mentioned in our website article. So check it out now. More on this topic. The article link is given in the description. Thank you for watching. Have a good day.